Welcome to this explainer. Okay, today we are breaking down the architecture of this Central Asian Dehkan farm structure. We're going to reveal this incredibly dangerous line between a massive tax oasis and a totally devastating industrial trap for growing agribusinesses. Look, if you're operating in places like Tajikistan, the legal structure of your farm literally dictates your profit margins and your ability to scale. So let's dive into how traditional management often gets this completely wrong and ends up triggering some really massive liabilities.
Here's our roadmap for today. We'll start off with the agricultural tax oasis, then explore what happens when you cross the processing boundary. After that, we'll look at the exporter's bottleneck. And finally, we'll engineer a structural solution using a dual-entity architecture and transfer pricing integration. Let's get right into it.
All right, part one, the agricultural tax oasis and the single land tax regime. To an uninitiated entrepreneur, this legal sanctuary looks like an absolute dream. I mean, it's the ultimate tax oasis because it strips away standard corporate tax friction almost entirely for raw biological yields. Your primary tax liability here is completely decoupled from your gross commercial turnover or your net operational profit. Instead, you're looking at a fixed statutory rate based purely on your land area and soil quality. Because of this, the revenue you generate from selling raw goods is legally exempt from the real heavy hitters. We're talking corporate profit tax, turnover tax, and even VAT. It is an unbelievable advantage. But you really need to pay attention to the fine print. It is exclusively restricted to primary unprocessed goods. Think harvesting raw cotton, picking fresh fruit out in the field, shearing raw wool, things like that.
Which brings us to part two, crossing the processing boundary and falling right into the processing trap.
So how exactly does this beautiful tax oasis turn into a total nightmare? Well, imagine you're operating purely in that farm oasis. You can wash, field sort, and bulk load raw apples all day long, and you are completely legally protected. But the exact second you change the physical form, the chemical composition, or the commercial classification of that produce, say you start extracting apple juice, fermenting cider, making dried fruit snacks, or even just putting things into branded consumer boxes, you've legally crossed the boundary from agriculture into industrial manufacturing. And just like that, you've triggered the processing trap.
Think of it like this formula right here. Your statutory tax status is a direct function of the depth of physical and commercial transformation of your product. If a bookkeeper or, an ambitious manager decides to run industrial processing activities inside the legal envelope of a standard Dehkan farm, they are making a fatal compliance error. It's a complete misunderstanding of the statutory definitions, and honestly, it compromises the entire entity.
Why is this so catastrophic? Picture this, a statutory audit rolls around. The tax authorities aren't just going to give you a warning. They will reclassify your entire commercial turnover as general industrial trading. You get retroactively stripped of all those amazing single-land tax exemptions we just talked about. Suddenly you are hit with a standard corporate profit tax of up to 18 or 20%, plus a 14% output VAT. And because you obviously weren't paying those originally, they're going to slap you with severe financial penalties across your entire revenue stream. It completely destroys your unit economics overnight.
And it actually gets worse. Let's look at part three, the exporter's bottleneck and the commercial thread.
You see, this processing trap isn't just a tax liability. It literally chokes your supply chain. You become what the industry calls a toxic counterparty. If you're an agro-processor trying to hide out in a basic farm structure just to dodge industrial taxes, your product is going to get systematically rejected by large-scale food conglomerates and international supermarkets. Here's why. Enterprise-level buyers operate under standard VAT regimes. When a massive supermarket chain buys packaged food, they absolutely need a standard electronic fiscal invoice with an input VAT offset to maintain their own unit economics. Since your basic farm structure is exempt from VAT, you simply cannot issue that invoice.
So, by trying to stay in that farm structure without VAT capabilities, you're essentially commercializing yourself as a toxic entity to the big institutional buyers. They will systematically reject you. The result? You permanently lock yourself out of lucrative international export markets. You end up entirely restricted to localized, low-margin B2C bazaars and informal cash markets. You've basically sacrificed your ability to scale, all for a completely misunderstood tax exemption.
So, how do we fix this? Part 4. The Dual-Entity Agribusiness Architecture, our structural solution.
A professional financial architect knows you don't just abandon those agricultural tax incentives when you want to process goods. Instead, you build a wall between the two. This structural setup is what we call a dual-entity architecture, and it lets you safely capture those high processing margins without contaminating your tax oasis.
First, you set up Entity A, the farm. Its only focus is 100% primary crop growing and raw harvesting. It holds the land rights and it pays that super low single land tax. Then, you incorporate a totally separate legal entity, Entity B, the processor LLC. This one handles the machinery, the consumer brands, and the industrial processing. It safely operates under the general tax regime, fully embracing the mandatory VAT and corporate profit tax.
Now for the final piece of the puzzle, Part 5, Transfer Pricing Integration. To make this dual structure completely legal and seamless, you've got to implement a compliant internal supply chain connecting the two entities. This is usually managed through automated ERP systems, like Odoo, for example. It works in 3 exact steps. Step 1. Entity A, the farm, sells the raw harvest to Entity B, the LLC, at a fully documented, market-justified wholesale transfer price. Since it's selling primary produce, the farm receives this revenue totally tax-free. Step 2, the LLC legally logs this purchase as an official operational expense, its cost of goods sold, which brilliantly reduces its future taxable profit. Step 3, the LLC processes the raw material into high-margin consumer goods, adds the branding, and then sells it to those supermarket chains or export markets with perfectly clean statutory VAT invoicing.
And right here is where the magic literally happens. The LLC's taxable base ends up being simply its branded retail revenue minus the raw transfer price and minus its processing cost of goods sold. By separating your raw production from your industrial transformation, you entirely preserve that massive single land tax exemption for all of your farming operations. But at the same exact time, you're building a fully transparent, VAT-compliant industrial enterprise that is ready for massive B2B scaling and international export. It's the best of both worlds.
So I want to leave you with this thought to help you audit your own corporate architecture. Look closely at your operations today. Are you out there trying to squeeze industrial value out of an agricultural tax shell? You absolutely cannot let your growth be restricted by a fundamental compliance flaw. So ask yourself, is your agribusiness truly engineered for scale, or are you currently sitting inside the processing trap?